what I want to do is to confront what I think is a popular myth about the gold standard. Now, Larry will confront some other myths, mainly of critics of the gold standard, but here I want to address what I perceive to be perhaps myths relating that are more common among people who are fond of the gold standard. The basic myth being that there was once a time when we lived in a gold standard paradise, and it had always been so until the fall came. The fall came either in 1933 or in 1971, or perhaps even earlier, depending on what episode you think involved the greatest sin. And we've been paying for our sins ever since. What I want to suggest is that this is a rather, this is an interesting myth of the gold standard, but things are actually much more complicated than that. And I want to start by taking us back to the founding of the United States, and particularly by having you imagine that you could time travel to that era, armed, equipped with a Federal Reserve note, and show the note to Thomas Jefferson, for example. You could pick any of the founders for this purpose, but Jefferson will do. And you said to him, "Mr. Jefferson, can you imagine? Look what they've done. They've replaced our gold dollar with one consisting of irredeemable paper." And my guess is that Jefferson would look at the note and look at you and say, "Gold dollar? What gold dollar?" Because at the time, nobody imagined that the dollar would be anything but a silver unit. It was, in fact, originally a unit based on the Spanish silver dollar. And it was intended that it should remain so with the drafting of the Constitution and the passage of the First Coinage Act of 1792 and in much subsequent legislation. All of the founders and all people at the time took for granted that basic money units or basic coins, which is the same thing back then, would be silver units, because that's what they were in the rest of the world, certainly the rest of the Western world. And so thinking of the new currency unit of the United States as a unit of silver was just following a very widely established precedent. In fact, until the latter half of the 19th century, the gold standard was essentially an unknown thing. The sole exception perhaps having been that of Great Britain, which adopted a gold standard officially more or less in 1816, but even then didn't quite admit what it was doing, if it even realized it. I'm reminded of a quip that another economist once made regarding a book by Hans Sennholz, who's a free market economist whose name should be familiar to many of you. He wrote a book called Gold is Money. And the remark made about it was that, well, if you translated that book title into French, you would have l'or c'est l'argent. And then if you back translated it into English, you'd have gold is silver. Because the French word for money is silver. It's the same thing, and that's because silver was money for such a long time. It was taken for granted that basic money units would be silver units. In Britain itself, by the way, the pound sterling was, as its name ought to suggest to you, originally a silver unit consisting of a troy pound of silver. That was a long time ago, but it took the British well into the 19th century to shake the idea that their money, that their pound and related units were anything other than silver units. Now, the U.S. switch ultimately to a gold standard, which would take place in stages in the course of the 19th century, was also completely unintentional. There was nothing intentional about it. It was an accident, and an accident that quite a few people came to regret. The first Coinage Act, which I mentioned, that of 1792, provided, of course, for the minting or coining of silver dollars, but it also provided for the free coining of gold eagles, which were $10 pieces. Now, there was a very prosaic reason for that, and it was not so that we could have a bimetallic standard, though this is in fact what the law ended up creating. It was so that we could have some coins for very large transactions, because if you think about it, right, a silver coin, that is a full-bodied silver coin worth 10 times as much as a silver dollar, would have been about as big as a pancake, and therefore rather clumsy to carry around. And so the idea was to have $10 pieces made of gold that wouldn't be so clumsy. But in those days, remember, nobody thought that coins could pass for anything other than their actual metallic content. And that perspective, plus the desire to avoid paper money, certainly on the part of Jefferson, meant that you had to have full-bodied coins circulating according to the value of the metal they contained, which meant gold and silver for convenience, particularly if you wanted foreign trade to be handled as well as domestic exchange, and that meant bimetallism. That is, a dollar that was unwittingly defined not in terms of silver only, but in terms of two metals, silver and gold. A problem well known, I'm sure, to most of you with bimetallism is that in practice, if the implicit valuation embodied in the gold and silver coins of gold and silver, that is, if the implicit gold-silver exchange ratio differs from the ratio at which those metals trade as commodities in world markets, then either the silver will be officially undervalued or the gold will be officially undervalued. Well, depending on which metal is undervalued, that one will not be brought for coining to the mint, and you will end up with the other metal being the de facto, if not the official, standard metal. For about 40 to 45 years, the official valuation of silver and gold as embodied in the silver dollars and the gold eagles was such that silver was the legally overvalued coins, so there were not very many gold eagles produced, and we had, in effect, a silver standard, which was what the founders had intended. What they didn't intend, of course, was that there wouldn't be many eagles produced, which raised problems for large-scale transactions. After the gold finds of Appalachia, particularly, this is around 1834, and also as a result of a change in the official weight of silver coins, silver ended up being not overvalued, but undervalued. And it was at that time that silver stopped being brought to the U.S. Mint for coining, and gold instead was the only metal that it was profitable to coin. At that stage, you might say that we moved towards a gold standard, except in practice, we didn't, for the simple reason that eagles were still the only gold coins, and they were absolutely useless for most transactions. So we ended up with silver coins that were old and worn, becoming our media of exchange. In other words, we were still on a silver standard. You might call it a worn-out silver standard. And the worn-out silver standard remained our standard, even though silver wasn't being freshly coined for some years. Now, ultimately, the gold rush in California sealed the fate of the silver standard, that and the fact that the silver coins had become very deteriorated, but gave rise to more aggressive gold coining. But by then, the legislation had been changed so that silver coins were being made, not dollars, but smaller denomination coins that were avowedly token coins. That is, the silver in them was meant to be less than the commodity value. And those coins, of course, could stay in circulation, but they had to be minted on the government's own account, not freely, because nobody would use silver. If people had been able to make token coins just by bringing their own silver to the mint, then they could have made quite a bundle doing that. So the government produced small silver coins. Gold was produced, but still was only good for large transactions. And silver dollars, well, they hadn't been seen for a long time. Now, the Civil War meant the suspension of gold and silver payments, of course, and a temporary fiat standard that would stay in effect until 1879. During the intervening years, many other countries found, also as a result of the falling world value of gold, that they too had inadvertently, or in some cases intentionally, switched from silver to gold standards. Many had had bimetallic legislation themselves, and so Gresham's law encouraged their switching also. After the Civil War, the United States found itself joining these other countries in what became the classical gold standard. But again, with few exceptions, nobody had intended that this should be the result. It was, as it were, the outcome of a series of accidents around the world, one of the important ones being, of course, those California gold discoveries. It wasn't finally until the passage of the Gold Standard Act in 1900 that the United States officially declared itself to be not on a silver standard, not on a bimetallic standard, but simply on a gold standard. I want to add one more thing. The ultimate de facto switch to an official gold standard, even before it was acknowledged, was highly controversial. As many of you know, the decision to stop producing silver dollars, which was made official in 1873, even though such dollars had not been minted for a long time, was later considered by many to have been a crime. Nobody thought they were committing a crime at the time. They simply took the silver dollar off the list of coins that the mints would make because they hadn't been making them anyway for so long. But when, after 1879, people realized that silver had been effectively demonetized and gold had been raised to the official standard, there was a great outcry by persons particularly associated with the agricultural parts of the country who were faced with the deflation that they associated with the gold standard and which they felt a silver standard would have avoided. That was, of course, the basis for William Jennings Bryan's famous campaign. He campaigned for the revitalization of the silver standard. He ultimately lost, but he gave a great speech about the cross of gold. In any event, we ended up on a gold standard accidentally, and the world ended up, or most of it ended up on a gold standard. And this international or classical gold standard that prevailed in the last decades of the 19th century and the first decade or so of the 20th had a number of wonderful features. But the features, to a very large extent, were not specific to gold. That is, there was nothing about it being an international gold standard that made it work so well. It was the fact that it was an international metallic standard that really was key. That was, of course, the key to the fixed exchange rates. This was the only successful system of fixed exchange rates ever known, but it could just as well have been a system of fixed exchange rates among silver currencies. It just didn't work out that way. Similarly, the stable real purchasing power of gold, and that purchasing power was remarkably stable over the period in question, could equally have been a stable real purchasing power of silver. In fact, Milton Friedman, looking at the real price of silver throughout the period roughly from when Britain went on the gold standard in 1819 to the end of the 19th century, Friedman found that the real purchasing power of silver was actually a little bit more stable than that of gold. And he points out, the more countries that had remained on a silver standard, the more stable that standard would have been. So we could very well be talking today, if it hadn't been for a number of accidents, about the wonderful silver standard that was even more stable than the actual gold standard that existed during that period. Finally, one more thing which should be said about the classical gold standard. Another reason why it worked so well, which also was not due to its being based on gold rather than silver, was the fact that it wasn't managed by central banks. This is something that really needs to be insisted on. Many of the participating countries in the classical gold standard, including the United States, didn't have central banks. Canada, another major participant, had no central bank and also had a very stable financial system. Switzerland didn't have a central bank for most of the period in question. Sweden didn't have one before 1901. And it can be argued that the standard, the international classical gold standard, worked well because there were no central banks around to muck it up. When the Bank of England, which was of course around, did try to interfere with the operation of the gold standard, it usually did so to try to controvert the normal workings of that standard, which tended not to add to its stability, but to create short-run instability. Finally, I'd like to point out that the gold standard, the classical gold standard, didn't last very long. If we can agree that it really kicked in after the Civil War, it was over in 1914. Some would argue that the gold standard in this country only ended later, in 1933 perhaps, when Americans lost their right to convert paper money into gold. Or possibly in 1971, when foreigners, that is foreign central banks, lost that privilege. But I would submit that the gold standard as a self-sustaining, stable standard was finished with the outbreak of World War I, when, of course, all the belligerent countries went off the gold standard to some degree. Even the United States in 1917 placed an embargo on gold exports, which could be regarded as a partial suspension of the gold standard. After the war, in the course of the 1920s, all countries tried to restore the gold standard in some fashion, some after devaluing their currencies, that is, making their paper monies worth less than before in gold. Others, like Great Britain, tried to reestablish their old parities with ultimate lack of success, it should be said. But the process, the gold standard that was recreated between the wars, was not a true gold standard, and more importantly, was not a sustainable gold standard. It was a gold standard that had the same quality as the tape recorder in the beginning of Mission Impossible episodes. It was programmed, in this case unintentionally, to self-destruct, not in 5 seconds, but in something like 5 years. It was a standard that was jury-rigged, that depended on most countries making their holding as their reserves not gold itself, but sterling, that is, British pound credits at the Bank of England, and in some cases, Federal Reserve credits. The system only worked if all the countries agreed to keep those credits and not cash them in. The reason it had to work that way was because there wasn't enough gold around to sustain the high price levels and money supplies that still existed after the war, despite some deflation, and without further devaluations. It was a house of cards. And when the French, who always spoil these things, decided to cash in their chips, let it never be said, by the way, that the English can have a monopoly on sentiments about the French, particularly when it comes to international finance. But in this case, I think in a way the French deserve some credit. Someone had to wreck that lousy system. It was bound to happen. Why not let the French do it? They're so good at wrecking things. If only they would wreck the euro as effectively, we would be in much better shape. So it all comes tumbling down after 1930, and this is a big part of the story, of course, of the Great Depression, a story we cannot go into in any detail. After World War II, another attempt was made to cobble together something that looked sort of like the old gold standard. It also had the fixed exchange rate feature of the old gold standard, and yes, gold was behind it, sort of. This was the Bretton Woods system. But the Bretton Woods system had all the bad features of the interwar gold standard and then some, because unlike the interwar gold standard, in the Bretton Woods system, it was understood up front that countries might devalue their currencies under certain circumstances. There wasn't an absolute commitment to gold parities established after the war. Well, that, of course, just made the thing that much more vulnerable to speculative attacks and that much more likely to destroy itself, and inevitably to do so eventually. It didn't get working, by the way, till 1958, and it was falling apart by 1967. So 9 years is the longest life you can attribute to this system of inherently unstable fixed exchange rates, based this time not on sterling but on the US dollar. Other countries were expected not to cash in their dollar chips, and then everything would be just fine. It would be especially fine, of course, for the issuers of dollar chips, or the issuer, the Federal Reserve System, which naturally issued plenty, especially after the Vietnam War. Guess who decided eventually that they were tired of holding these chips and that they would destroy this international system? The French. Once again, if they would stick to destroying international monetary systems instead of trying to create them, they wouldn't be so bad. But they did destroy this one after '67, and finally the American authorities closed the gold window in '71 after being unable, despite various attempts to restrict gold conversions and make them visible and try to use diplomacy to force countries not to cash in gold. They finally gave up in '71, though the gold standard officially wasn't abandoned until 1976. So, the gold standard was a very brief episode, the real gold standard, and an accidental one. And silver could have been just as good. Perhaps it would have been better as an international standard. So does that mean we shouldn't be talking in this session about returning to gold? Should it be a session about returning to silver or even to bimetallism? No. I'm glad to say, for the sake of my colleagues, because I'm sure they're anxious to present their papers, gold has become a focal point for discussions of sound money for good reason. We actually had an international gold standard. It actually worked very well. And you can't compare the hypothetical of an international silver standard to the reality of this well-working system. Surely, however challenging it might be to try to get people to take the idea of reestablishing a gold standard seriously, trying to get them to do so with regard to a silver standard about which they understand even less would be too great a challenge to bother trying to meet. Thank you very much.
Some of you may have noticed that in the Republican Party platform, there's a call for a new gold commission. Well, they don't use the word gold. A new commission to consider putting the dollar on a metallic basis. Now, that kind of sentiment, those kinds of expressions have, of course, brought forth critics of the gold standard. So I'm here to talk about some of the arguments they've offered in recent years. Now, the challenge before me is not that these arguments are really hard to refute. The challenge before me is that they're so easy to refute that you'll think I'm just setting up straw men. So in the paper, I actually will quote these arguments at length to try to convince you that they're setting up the straw man. I'm just knocking it down. But I think it's a useful service because some of these arguments sound plausible if you don't know anything about monetary theory or anything about economic history. Now, some of the authors of these arguments do know better, and so it's actually kind of shocking in some cases how flimsy the arguments are. I'm going to focus on two economists in particular. One, the UC Berkeley economist Barry Eichengreen, who last year published a piece in the National Interest called A Critique of Pure Gold. And the other is an obscure former Princeton professor named Benjamin Bernanke, who used to be on the Council of Economic Advisors, so maybe you heard of him then. He gave a guest lecture at George Washington University recently, and in the New York Times account of this lecture, he, quote, framed much of this history as a critique of the gold standard, which was dropped in the early 1930s in a decision that mainstream economists regard as obviously correct, hugely beneficial, and essentially irreversible. But the criticism of the gold standard is bipartisan. Well, Bernanke was appointed by a Republican president. I'm also going to mention James Hamilton from University of California, San Diego, who is a monetarist, and Bruce Bartlett, the one-time supply-side economist, for some reason joining the pile-on. So the first argument I want to consider is probably the simplest. There isn't enough gold to operate a gold standard today. And I attribute this one to a columnist for USA Today, but there are other examples. And there is a very facile answer, which I think is not correct. The facile answer is, well, we just raised the price of gold, as far as necessary to make the value of our gold stock equal to the value of our money supply. Well, what would that take? That would take something like $8,000 an ounce. And you can't really do that when the world price of gold is $1,600 an ounce, because the United States would be flooded with gold, which would be used to buy assets and goods and services, and we would end up selling an awful lot of stuff to the rest of the world in exchange for gold. So that's a very expensive piece of advice. The reason we don't need to do that, fortunately, is that the money supply can be a multiple of the stock of gold, and I'm going to argue it is when you don't intervene to stop that. And this the USA Today columnist seems to have misunderstood, each dollar of money can be spent more than once a year. All right, so you can't just compare $15 trillion of economy to however many billion dollars of gold there are and say that's not enough. Right? Money can be spent more than once a year. Right, so I'm assuming that a gold standard does not mean a monetary system in which people just use gold coins and nothing else. I believe in modern banking. Well, not what we have today, not postmodern banking, in which there are no standards, but sound banking. Interesting footnote that comes from the book that Gary mentioned that, like all authors, I need to mention repeatedly so you don't forget the title, The Clash of Economic Ideas. Many of you may have heard the famous phrase attributed to Keynes that gold is a barbarous relic. The phrase he actually seems to have cribbed from a neoclassical economist named Edwin Cannon. And Cannon referred to that relic of barbarism countries that only want to use gold coins and want to suppress the use of banknotes and checking accounts, right, which gives it a very different spin. Right? You can have a gold standard without limiting the economy to physical gold coins. So a gold standard, the way I'm going to use it, means gold is the medium of account. It's what things are priced in. And gold is the medium of redemption. It's the stuff that's in bank vaults that you can redeem your bank-issued money for if you want to, but in a properly functioning banking system, you very seldom will want to. Okay, so is there enough gold? Well, here's my back-of-the-envelope calculation, and I'm assuming that we're going to take the price of gold as it is today, around $1,700 an ounce. The U.S. government has 261 million ounces of gold. If you value that at $1,700 an ounce, it gives you $444.6 billion. That's about 4 times, a little more than 4 times, current required bank reserves. So it's more than enough to supply banks with all the reserves they are legally required to hold against their deposit accounts. If you think of it another way, if you ask how big a reserve ratio would it give banks against the monetary aggregate M1, which is the sum of currency in circulation and checking account dollars, it gives you about 19% against M1. And by historical standards, that's plenty. It's true, it's less than the official reserve ratio that was fastened on the Federal Reserve System in the days of the gold standard to try to, the interwar gold standard, not a real gold standard, to try to pin the Federal Reserve down. But when money was issued by commercial banks, this was a very healthy, more than necessary reserve ratio. So there's plenty of gold, at least in the United States. We'd have to sort of go around the world to see where the rest of it's gone. Here's an argument that Eichengreen makes. To use gold as money, quoting him, is to fix its price in domestic currency terms. And Eichengreen says this is very puzzling that free market advocates would want to fix a price, right? Don't they believe in freely fluctuating prices set by the market? Well, look, the official price of gold is not really a price, right? $20.67 an ounce was not a price. It was the inverse of the gold definition of the dollar, which was 1 over 20.67 of an ounce of gold. So it's not something that goes up and down with supply and demand. It's conventional or legislated or established by definition. In the case of the Spanish milled dollar, the U.S. Congress initially adopted what was the given content of that dollar in terms of how many grains of silver it was. So putting it into law didn't make something new up, it just codified what already existed. But once you've defined the dollar as a weight of gold, you don't have a fluctuating price between dollars and gold. They're the same good. What does fluctuate in response to changes in supply and demand is the purchasing power of gold, or if you like, the relative price of gold in terms of goods and services. And that does move in response to supply and demand, but it tends to settle back down to where it started, because if there's an increase in demand for gold that raises the value of gold, gold miners will start producing more, and they'll have an incentive to produce more than usual as long as the purchasing power is higher than usual. But that in itself will drive it back down. And likewise on the other side, I actually used this quote from Eichengreen on an exam I gave last week to my students, where the exercise is spot the fallacy. Right? So here's how silly it is to talk about this as an example of price fixing. I couldn't get a picture of Eichengreen going to his bank, but I got a picture of this gentleman withdrawing money at his bank. I doubt Eichengreen regards it as a case of price fixing, that every time he goes to the ATM, in exchange for giving up $1 of his checking account, he gets one Federal Reserve note dollar. That's not a fixed price, right? That's the one-for-one definition of what a dollar in a checking account means, according to the contractual terms with his bank. So that's not a price-fixing ratios. And likewise, if you go to the bank and get 1/20th of an ounce of gold for turning in $1, or whatever the ratio would be today, that's not price fixing. That's the definition of the monetary unit in terms of gold. While I was looking for an ATM picture, I found this one. This is in the airport in Dubai, where you have an ATM that spits out little biscuits of gold. So, see, modern technology is keeping up. The gold standard is not an old-fashioned system. Third argument I want to consider. People look at the volatility of the price of gold in recent years and say, well, you'd be insane to hitch your money to gold because gold is all over the map. As Brian was telling us, it's shot up to $1,700 an ounce. And Eichengreen and others talk about the inherent volatility in the price of gold. And Jim Hamilton, who I mentioned, has a calculation as to how much nominal wages would have had to fall to keep them the same in real terms if they had been fixed in gold, right? Because as the value of gold goes up, you have to get fewer gold dollars. But it's a crazy calculation, because the reason the price of gold has gone up to $1,700 is that people are buying gold as an inflation hedge. I think that's pretty obvious. And so that's a problem, or it's a symptom of a problem. It's a symptom of the unreliability of fiat money, but it's a problem experienced under fiat standards. It's not a problem experienced under a gold standard. Under a gold standard, you don't buy gold to speculate against inflation, right? Gold is the monetary standard. And you look at historical experience, there's basically no inflation. Certainly over the medium to long term, there's no inflation. Hamilton has a different view. He wants to claim that the reason the price of gold is shooting up is because of a surge in income in emerging economies. And he cites 1 year's worth of data in which the purchase of jewelry in India, gold jewelry in India, shot up. But if you look over a longer period of time and more countries, you see that the volatility in the price of gold is driven mostly by investment demand, what they call investment demand, which is people buying coins, bullion, and exchange-traded funds in gold. Even jewelry purchases in India are partly an inflation hedge. Right? People buy gold because they figure the price is going up. They figure the purchasing power of the rupee is only going down. I think Shikha can confirm this. Yes. So what we need to ask is, under which system do you have greater volatility? Under which system do you have less volatility? So here's someone buying a gold biscuit. And the simple fact, the historical fact is that money supply and demand shocks have been worse under fiat money systems. Right? This is not a necessary truth, but it is an empirical truth. Under the classical gold system, there were some supply shocks. You've heard about the California gold rush, but you may be surprised to learn how small these shocks were in terms of the impact they had on the purchasing power of gold. So the California gold rush, followed just a couple of years later by the Australian gold rush, was the largest supply shock under the gold standard. Huge outpouring of gold. It cumulatively raised the world price level by 26%, but that was over a stretch of 18 years, from 1849 to 1867, and that's the point at which the world price level stopped rising. If you work that out, that's an inflation rate of 1.3% per annum, right? And that's the worst case. The average over the entire period in which Great Britain was on the gold standard was 0.1% inflation. Right? So very, very close to zero. In fact, if you choose different starting and ending points, you can get a little bit positive or a little bit negative. So very close to zero. On the demand side, you don't have big shocks to the demand for gold when gold is money, because there's no reason for people to want to hoard money as an inflation hedge. Well, right, that's self-defeating. Or to think that the price of gold is about to jump upward and therefore want to hoard it. What we do have this problem today under fiat money, and I cite an article by Robert Barrow who identified this in the 80s, where he said, look, since we delinked from gold, we see a lot more volatility in the inflation rate, and that's because when people see inflation coming, they now want to hold less money and move into real assets. So in terms of monetary theory, the velocity of money goes up, and that drives the price level up as a kind of one-time adjustment as people are shrinking their money holdings. But when you have volatile inflation expectations, as you do under our current regime, you get volatile behavior in the demand to hold money. Under the gold standard, you did not have volatile inflation expectations. Inflation was anchored. People's inflation expectations were anchored. So you didn't see these kind of demand shocks, which are the creature of a fiat money regime and not of a gold standard regime. Well, some economists have noticed that the gold standard didn't in fact produce secular inflation, and they want to use that against it. So they say, well, it would be a source of harmful deflation. I mentioned Bruce Bartlett earlier. Bartlett argued in a recent piece that the long-run inflation rate under the gold standard was close to zero only because periods of inflation were followed by periods of what he called debilitating deflations. My colleague at George Mason, Tyler Cowen, has made the same argument, that the problem with the gold standard is that sometimes the purchasing power is going to go up, and that means deflation, and to quote him, thereby harming output and employment. But the thereby is just a non sequitur. We have to distinguish between harmful inflations, there is a kind of harmful inflation, and benign deflation, between harmful deflations and benign deflations, or good deflations. And George Selgin's book less than zero, the case for falling prices in a growing economy. Is that right? Freely available on the web, so I'm not giving George any additional income by mentioning this, but maybe some additional citations. I recommend very highly as making this distinction, but other economists have belatedly started to recognize it. There was a piece even in the American Economic Review by Atkinson and Kehoe, which they go through all the historical cases they could find of deflations, defined as falling prices over a 5-year span. And then they asked the very simple question, was output also falling over that 5-year span? So was there a depression over the same span that there was a deflation? They count 73 episodes of deflation, so this is looking at many countries over many years. Only in 8 out of 73 cases was there shrinking output. Right? So there's no overall association. Oh, by the way, there was shrinking output in some cases where there was inflation. There's no overall connection between falling prices and falling output. And it should be obvious that if you keep the money supply constant or growing very slowly, you're going to have falling prices when the output of goods is growing rapidly, right? You have the same number of dollars chasing more goods, or more goods chasing the same number of dollars. You're going to have goods selling at lower prices. But you can't regret that. It can't be harmful to have deflation driven by rapid output growth. Rapid output growth is exactly what you want. In the paper, I look at the longest period of deflation under the U.S. gold standard, which is 1882 to 1897, so that's 15 years. Prices fell at a compound rate, annual rate of 1.7% a year, right? So that's nearly 2%. That sounds like it could be pretty damaging to the economy, but if you look at real output in the economy, that was growing at 3% a year over the same period. Right? So it was hardly restraining economic growth. That was about the average of the 19th century. And this is the sort of thing, right, where this Tandy computer used to be $5,000. It did have 2 floppy drives after all, so that justified the high price tag. But deflation driven by productivity is a case where particular goods get cheaper to produce, their price falls. Why should we regret that? To say we should regret the price index falling is to say when we have cases like this, we should offset them by making sure other prices all go up a little bit. Right? That doesn't make any sense. There's no problem created by a good becoming cheaper to produce and therefore producers bringing it to market and selling it at a lower price. The reason, of course, deflation has a bad reputation is the Great Depression. So I need to talk now about the Great Depression. But the Great Depression was not a case in which prices were falling because the economy was flooded with output. It was because the money supply was shrinking so rapidly. That's a very different story. In that case, you do get unsold inventories of goods if prices and wage rates are sticky coming down. But that's a different thing from the typical deflation under the classical gold standard. Now, some people have worried in recent years that clearly the Federal Reserve's actions during the financial crisis saved our bacon, kept us from plunging into the abyss. Therefore, we want to have a central bank that's able to do whatever's necessary. Therefore, we don't want a gold standard because that ties the government's hands. All right, that's the argument. Well, here's Ben Bernanke at George Washington University. He says, a gold standard means that no matter how high the unemployment rate goes, you've promised not to try to do anything about it. Well, that's right, but I don't regard that as a shortcoming. I regard that as a virtue. And there's a well-known argument according to which it's a virtue. Here's the classical version of it, right? Where you get better outcomes by restricting your own discretion. This is Ulysses tied to the mast so that he can hear the song of the sirens without being tempted to steer the boat over onto the rocky shoals and smash the boat up. There's a similar problem in monetary policy, which is sirens are singing in Ben Bernanke's ear saying the unemployment rate's too high, you have to bring it down. And in doing so, he's tempted to print more money than is consistent with keeping the value of the dollar stable. All right? We want his hands tied against that sort of thing because unemployment is not a monetary problem. I mean, it can be a side effect of not having enough money, but if he just makes sure that we have enough and not too much money, and if he takes care of monetary equilibrium, the labor market is another thing that can take care of itself. And trying to cure labor market problems by printing money gets you into a race between the printing press and the labor unions. You don't want to go there. We've been there. Right? Not a pretty story. So let's get to the argument that the gold standard amplifies business cycles. This is meant to be a picture of a bank run. I realized after I put it on the slide that it kind of looks like people looting the bank, but it's meant to be a bank run. And the worry of some economists, and I quote Tyler Cowen again in the paper, is what they call the pro-cyclicality of the money supply. That is, when times are bad, people will pull their money out of the bank. That'll make the money supply shrink. That'll make the economy even worse. Right? So it'll amplify the business cycle in that way. But it's not true that a gold standard makes the money supply more pro-cyclical, because it's not true that it leads to bank runs or credit crunches. Now, in the U.S., there happens to be a coincidence in U.S. history between the period of the classical gold standard, the late 19th century, up to the founding of the Federal Reserve, and weak banking system and financial panics. But the U.S. is not the only country in the world. If we just look north of the border in Canada, during the same period, also on a gold standard, there are no financial panics. Right? There's some spillover from the U.S. panics, but there are no Canadian panics. People are bringing their money into the bank while the U.S. is having bank runs. So it can't be the gold standard that's responsible. It's got to be something different between the two countries, and the different thing is Canada had a rational banking system because they didn't restrict the banks in ways that made them weak. They didn't restrict branch banking the way we did in the United States, and they didn't put a limit on the amount of banknotes banks could issue depending on how much government debt they owned. We did that in the U.S. because it was a way of financing the Union government during the Civil War. Right? But it meant the banks couldn't provide more currency in seasons where there was a peak demand for currency, and all the financial panics began in the autumn because that was the peak season for demanding currency. Banks that couldn't issue their own currency had to give up reserves, and now there's a problem. There's not enough reserves to go around. So let's talk about the Great Depression. There's a famous thesis called Golden Fetters, which is associated with Barry Eichengreen's 1992 book by that title. Then the phrase Golden Fetters comes from Keynes, so that gives you a hint as to where Eichengreen is coming from. But there are kind of two parts to the thesis. First part is that the gold standard, and I quote Doug Irwin from Dartmouth as to what the thesis is. The gold standard was the key factor in the origins of the Great Depression. So that's part one. And part two is a key factor in the transmission of the Great Depression from country to country. So let me first deal with the deflation question in the United States. This is a picture of the paper currency that was issued in Great Britain. It's actually a 10-shilling note, which is a pretty small denomination, during the First World War. And the real problem of the deflation, well, to understand the deflation in the 30s, we have to talk about the interwar period as a whole. You've already heard a little about it and how it wasn't really a true gold standard. It was a jerry-rigged gold exchange system. And to understand the interwar period, we have to go back to World War I. And I put most of the blame for the interwar deflation on the First World War's monetary experience, which was inflation, of course. Countries went off the gold standard in order to print money, in order to pay their war bills. The great economist Leland Yeager was once asked, would you recommend going back on a gold standard? And he said, yes, I would, but I would also recommend that while we're doing it, we repeal the First World War. And that's kind of my position, too. But what happened in the First World War was, as I said, the governments issued a lot of money. In Great Britain, the price level basically doubled. So at the end of the war, you've got a pound which buys half as much as the amount of gold that the pound used to be equivalent to still buys. Right? So how do you bring those two things back into alignment? You have a choice. You either cut the gold content of the pound, or if you want to keep the gold content of the pound, you're going to have to bring the price level back down, which means you have to go through a major deflation. And unless you can adjust prices and wages flexibly, that's going to be a problem. And of course, Keynes was famous for warning that this was a bad idea to go back to gold at the old parity, but he wasn't the only one to warn this. Mises warned against the same thing. Mises said, look, the damage done by the inflation has been done. You don't reverse it by now having a massive deflation. And I like his analogy. He says, once you've run over a man with a truck, you don't do him a favor by putting the truck in reverse and backing over him. Right? So the sensible thing to do, even though you would like to have a system that retains the same parity, once you've had a world war, you can say, okay, in that case, once we've doubled the price level, now the sensible thing to do is devalue, cut the value of the pound in half, the gold value of the pound in half, and then we can sustain that value. But instead, they tried to go back to the old parity without enough gold to do it, with a price level so high that if you could get gold, you would take it, right? Because gold had a bigger purchasing power in the world market than the number of pounds it took you to get the ounce of gold. Those pounds only bought half as much. So gold was massively hemorrhaging from Great Britain, and they couldn't sustain it. So countries that did that were going to have a deflation. In the US, we had a big deflation in 1920 and 21, but it didn't entirely reverse the inflation the US had during the war. But countries in Europe had even more inflation than the US did, so they were way above the gold parity, and they had to make this choice. And so many countries went back to the original standard that there was going to have to be a deflation. How many have I got left? Oh, I'm over. Okay. The gold standard spreading to the rest of the world, I think there's a grain of truth in that, but there's a little more to the story that needs to be mentioned, which is the United States and the Bank of France again, as George mentioned, were ruining things by stockpiling gold. They weren't playing according to the normal rules. They were gathering up so much gold and just putting it in vaults and not letting it affect the money supply that other countries were losing gold. And I think there is an important lesson here, and the important lesson is you don't want to go back onto a gold standard with central banks. You want a gold standard where the right to issue money is more decentralized than that. You don't want to have an institution which has the power to overissue money and then has the power to suspend payments. In a system of decentralized note issue, a free banking system, any one bank can devalue, can't devalue. Any one bank can go broke, but it doesn't make the monetary system change. It doesn't devalue the currency. It affects that bank. It doesn't affect the entire system. So nobody is in a position to devalue. And because no bank is going to be relieved from the mistakes it made, banks are going to behave more prudently. And that's the answer to the last one I have time to cover, which is that a gold standard system would be subject to speculative attacks, like George Soros launched against the pound in 1991, and like took place in the United States in 1933 when it was suspected that Roosevelt was going to devalue. If nobody can devalue, then there's no reason for a speculative attack. There's no profit to be made by borrowing money, waiting for the devaluation, and then repaying the loan by buying back the currency you borrowed at a lower price. So I'll have to end there. Thanks very much.
Why did Milton Friedman not favor a gold standard?
Well, Milton Friedman was of the optimistic view that we could get a paper money standard that would be just as sound as a gold standard and spare us the resource costs. At least that was his view in the 1960s. He became a little more cynical. He started to read some public choice, and he realized the Fed wasn't going to give us sounder money. And in the 1980s, he started saying, we need to shut down the Federal Open Market Committee But he didn't favor going back to a gold standard. Then he favored freezing the monetary base and letting banks once again issue currency if the public wanted to hold more or less currency. But I think the thing that really concerned him was the resource cost question, and he thought that we could have a paper money that would be just as sound without having to dig it out of the ground.